Many people think that buying a business, you need to have a big pile of cash. That's not exactly entirely true. Most of the business I've seen and done requires very little money. In this video, I will explain to you how the actual no money down works and how the seller finance works and when this is a good deal structure or not. If you're looking to move into buying a business and M&A or transitioning from property into operating companies, understanding deal structure is just as important as understanding the numbers. Let's clear something straight away. No money down does not mean no money involved. It could be no money up front. Usually money flows is just over time. It usually means the business pay for itself from the future cash flow over a period of time. Seller finance, what actually means? Seller finance means the seller becomes the bank. It could, after the business is being valued, we agree a valuation, there will be some sort of arrangement of a portion that can be paid up front and the rest will be deferred, either paid monthly or quarterly, and usually it's often tied up to performance. So let's say a business is worth £1 million. You could put a deposit of 300k to 500k as a deposit, and then the rest could be deferred over a monthly, quarterly payment over 5, 6, 7, 10 years. Depends what the agreement you have with the seller, and it's paid from profits. Now, there's a quick tip here. If the seller believes in the business, seller finance is a strong signal. If they don't, then there's your key information right there. Now, of course, not every business or every seller will agree to this, but I can give you some of the reasons why sellers will agree to this. One of them would be tax efficiency, retirement income, no prospective buyer, so you could be his only offer. Wants the legacy to be protected and wants to make sure that he's got certainty and believes in the business being stable. Most of the sellers don't want a higher price. They want stability, certainty. The risk that nobody talks about. Now, when you're structuring this no money down deal, you have to also bear in mind about the cash flow strain, seller interference, unrealistic add backs, personal guarantees, also over optimistic projections. No money down deal fail when people structure optimism instead of reality. So you need to be really, really good on the numbers. You have to look proper at the numbers. How I think about deal structure. For me, it's about alignment. I want to make sure everybody wins from this deal. I want to make sure that the seller is treated fairly, because obviously he spent so many years building this business, going through blood, sweat, and tears. So I want to make sure everybody wins. If the business performs well, everybody wins. If it doesn't, then I don't want to have the pain from day one. And the way I'm thinking, and this way of thinking applies to any sort of business that involves real operations. In the next episode, I'll break down how I assess the risk when buying a business and structuring the deal like this. So if you're interested in business acquisitions, M&A, or buying UK businesses, this is the channel for you. I explain here the whole process using short videos. So make sure you like, share, and subscribe to this channel. And don't forget to hit the bell icon so you get all the notifications and you'll be the first one to know when I'm going to post a new video. I usually post it once per week, either Sunday evening or Monday. Thank you for watching, and I'll see you in the next video. Take care.